Now it's opening, dear.
Ma'am, it's not downloading.
Why I don't know? What happened? I have resent it already.
Ma'am, I think there's some network issue on my side.
Yeah, that's why it's network issue on your side.
Yes, ma'am, it's opening.
It's opening. Okay, fine. So take page number 11. Modern approach. Taken?
Yes, ma'am.
Yeah. So modern approach, in bracket you can write clear, CLEAR, all capital letters. Now what is this C? C means capital account, drawing account. Last class we learnt how to apply the rules of debit and credit on the basis of traditional approach. And now we are going to learn how to apply the rules of debit and credit on the basis of modern approach. Modern approach as compared to traditional approach is very easy, and in order to do the practical questions in accounts we use this method only. It is very easy to understand. Now C stands for capital and drawings account. L stands for liability, liability of the business, like any outside loans. Suppose business has taken loan from any bank, or any creditors, business needs to make payment to the creditors. So all the liabilities of the business comes in L. What about E? E refers to expense. Expense means like rent account, salary account, any expense paid by the business. Now what is asset? Asset means plant and machinery, land and building, furniture and fixtures, goodwill, all these are assets. Now R for revenue. Revenue means sales, income, interest, any income of the business. So CLEAR, this 5 clear you have to remember. C stands for capital and drawings. L stands for liability like creditors account, loans account. Expense stands for expenses account of the business like rent account, salary account. Assets, plant and machinery, land and building, furniture, fixtures, goodwill. Revenue, sales, income, interest. All these. Now, as per modern approach, what is the rule of debit and credit? That's we are going to learn. So, first comes the capital. CLER, clear, capital comes. Whenever in business capital increases, we have to credit the capital account. When the capital will increase in business? Whenever the owner of the business introduces the capital, or he brings any additional capital, then capital of the business will increase, then you have to credit the capital account. Now when you will decrease or when you will debit the capital account? Whenever the capital decreases. So capital, when the capital decreases, whenever drawing is done, whenever owner of the business makes drawing, he takes the cash for his personal use, then capital decreases. If he withdraws capital from business, then capital decreases. So whenever capital decreases, you have to debit capital account. Whenever capital increases, you have to credit the capital account. So first one, this capital concept is clear, when you have to credit capital account and when you have to debit capital account. Manjusha? Yes, Manjusha, can you hear me? Manjusha, am I audible to you, dear? You are not audible to me. I can't hear you. Yes? Okay. Okay, fine, dear. Fine. Fine. Now the second, liability. Now what is the rule for this liability? Increase credit. Suppose liability of the business increases. You have to what? Credit the liability account. For example, creditors. Business is purchasing goods on credit. Then creditor will increase. Creditors comes under liability. Liability is increasing. You have to credit creditors account because it's a liability. So you have to credit liability account and vice versa. Suppose liability decreases, then you have to debit. When the liability of the business will be decreased, suppose business is making payment to the creditors. Business is paying to the creditors. Creditor is a liability. So whenever payment is made by business to the creditors, creditors will get reduced, creditor will decrease, then you have to debit creditors account, that is liability account. These are the rules of debit and credit you have to follow while solving the question. So far I taught you two things. First one, capital. Whenever capital increases in the business, and when the capital will increase, whenever owner of the business will bring or will introduce capital into the business, you have to credit capital account. When capital will decrease, whenever drawings are made, whenever owner takes the cash from the business for his personal use, then capital will decrease. You have to debit drawings account, that shows capital is decreasing. Second, liability. Whenever liability of the business increases, you have to credit. For example, creditors or any loans, all these are liability for the business. Whenever it is increased, credit the account, creditors account, loan account. Suppose liability is decreasing, you have to debit. For example, if the business is making repayment of the loan, if business is making payment to creditors, all these will lead to decrease in liability. So you will debit liability account. For example, creditors account debit, loan account debit. Whenever liability decreases, you have to debit. Whenever liability increases, you have to credit. Now the third, assets. Whenever any assets of the business increases, you have to debit the assets account. Whenever assets of the business decreases, you have to credit the assets account. For example, suppose business is purchasing plant and machinery. Now plant and machinery, it is an asset for any business. If business purchases, what is happening? It is coming into the business, assets are increasing, so you have to debit plant and machinery account, debit furniture and fixtures account, debit land and building account, debit. Why we are debiting all these assets account? Because it is increasing. When the asset will increase? When the business will purchase these assets. Now when the asset will be decreased? When the business will sell these assets. For example, plant and machinery business is selling to some other person. So it is decreasing, plant assets are decreasing, then you have to credit the assets account. You will write to plant and machinery. So simple logic, whenever any asset increases in the business due to purchase or any other reason, then you have to debit assets account. Whenever assets of the business decreases, maybe the assets are sold by the business to any person or any company, then you have to credit assets account. Any doubts so far, Manjusha? Is it clear? Are you writing, dear? No, ma'am? Okay. Okay, fine.
Hello? Ma'am, am I audible?
Now you're audible, dear. Lot of network issues are today. Oh,
Yes, no, I don't know. It's a little cloudy and all outside.
okay,
Also,
okay.
internet inside the house too.
Okay, dear. Okay, dear. Now you are audible, dear. So, next, expense account. Now, expense means any expense of the business like rent paid, wages paid, salary paid. All these are expenses of the business. Expenses of the business if increases, you have to debit that account. Suppose business is making payment of rent. Rent is an expense, rent paid, so rent account debit. Suppose business is making payment of salary, so salary account debit. Suppose business is making payment of wages, wages account debit. Any expense, whenever business makes or business pays any expense, you have to debit that account. Suppose any expense decreases, then you have to credit that account. Expense account you have to credit. Now we are coming to our revenue. Now what is the rule for revenue? Any increase in revenue you have to credit. For example, what is revenue? Revenue means income of the business. Now what are the incomes of our business? Sales. Whenever goods are sold by the business is earning what? Income only, revenue only. So sales account you have to credit to sales account. Suppose any interest received, any discount received, any commission received, all these are income for any business. So you have to credit all the incomes of the business, you have to credit. When you will debit if any income of the business is decreasing, then you have to debit that income. So just 5 things you have to remember, like CLEAR. C stands for capital. Drawings, whenever capital of the business increases, you have to credit. Whenever capital of the business decreases, you have to debit. Liability, whenever liability of the business increases, you have to credit. Whenever liability of the business decreases, you have to debit. Expense increases, debit. Expense decreases, credit. Assets increases, debit. Assets decreases, credit. Revenue increases, credit. Revenue decreases, debit. So these are the rules of debit as per modern approach. You have to you have to segregate all the transaction of the business into 5 main heads. You have to identify whether a particular transaction involves capital, liability, or expense, or assets, or revenue. Then you should apply the rule of debit and credit. Accordingly, you have to do the sum. So if you see in CLEAR, E and A, that is expense and assets, will always be debited whenever they increases. So expenses of the business and assets of the business, whenever increased, we have to debit, and whenever expenses of the business and assets of the business decreases, you have to credit the account. Kindly note it down, each and everything. And for the remaining 3, that is capital, liability, and revenue. CLR, capital, liability, revenue, whenever increases, you have to credit the account. Whenever capital, liability, revenue decreases, you have to debit the account. These are the rules as per modern approach. Yes, it's clear, or you are having any doubt, Manjusha?
It's clear.
Okay. Okay, dear. Simultaneously write it down. Now you can take page number 13, 1-3. Modern approach, clear. Questions. Mention nature of accounts and on which side will increase in following accounts be recorded. So you have to write it down. Suppose building account, it is given in your question. So first always analyze what is building for any business. Building is an asset for any business. Now building account means, now you have to think, since it is an asset, so it has a debit balance. Debit balance means all the assets whenever increases we have to debit the account. So building account you have to debit. Why? Because it is an asset. Now creditors. Creditors means they are liability of any business. Business has purchased goods on credit. Now business needs to make the repayment. So it's a liability. Whenever liability increases, what you have to do? You have to credit. So for liability, you have to credit if it increases. Now Abhishek, in bracket they wrote proprietor. Means who is Abhishek? Proprietor means he is owner of the business. So always in our business we refer the owner of the business by capital. So this is capital account. What is this, Abhishek? Proprietor. This is a capital account. And whenever capital of the business increases, you have to credit the account. So capital you have to credit. Now purchases account. Whenever goods are purchased by the business, it is an expense for any business. Any business whenever purchases the goods, it is an expense. Now what you have to do? So whenever any expenses increases, you have to debit. So debit expenses. Purchase account is an expense. Till here any doubt, Manjusha?
No, no.
Okay, you are writing now simultaneously, everything write it down.
Yes.
Yeah, fine. Have you started going to school, dear? Have you joined the new school? Started going?
Ma'am, I started from
Okay, fine.
the first chapter in accounts. They finished the first chapter.
Okay,
Theory part.
okay. Okay, dear. Okay. So now for purchases we did. Fifth, carriage inward. Now what is the meaning of this term, carriage inward? See, whenever business purchases goods from any shopkeeper or from any other company, any other business, now the purchased goods of the business should be brought down to its godown. For that some transportation cost needs to be paid by the business. So that is known as carriage inward. You can write it down. These are the new terms, so kindly write it down. Carriage inward means the transportation cost paid by the business for bringing the goods at the time of purchase to its godown. Business is making purchase from any shopkeeper or from any other company. Then that goods needs to be brought down to business godown. For that transportation cost needs to be paid. That is known as carriage inward. So the transportation cost paid at the time of purchase of goods. That is carriage inward. Again it is an expense. What is carriage inward? Always expense for any business. It is transportation cost paid by the business. So you have to debit the account. Now cash account, cash is an asset. For any business, what is cash? It is always an asset. So whenever asset increases, you have to debit. So you can write debit. Next, rent received. Any received, like rent received, interest received, commission received. Anything received means always income for the business. And whenever any income increases, what is the rule? Income means revenue. So whenever revenue increases, you have to credit. You have to credit rent received account. Now interest payable account. See, one is interest paid, other thing is interest payable. Both are different. Both are not the same. So kindly write it down. Suppose interest paid is given in your question. It is an expense. Always remember, interest paid, salary paid, wages paid. Any amount paid, it is an expense. So it will debit because expenses are debited when they increase. But whenever Along with the interest, wages, salary, they are written as payable. This word comes, payable, interest payable. They didn't say interest paid. They are saying interest payable means interest has become due. Now business needs to make the payment of this interest. Yet business has not made the payment. Kindly write it down, these terms, for better understanding. This is different. Interest paid is different from interest payable. Both are not same. Interest paid is an expense, so it should be debited. Interest payable is a liability, because in future business needs to make the payment of interest. And suppose any liability increases, then what you will do? You have to credit. Whenever any liability increases, you have to credit the account. So interest payable, salary payable, wages payable, or outstanding salary, outstanding interest, all these are liability for any business. Business needs to make the payment in future. So all the liabilities have credit balance, means whenever any liability of the business increases, you have to credit the account. Interest payable, you have to credit. Understood, Manjusha?
Yes, ma'am.
Yeah. So have you written a small note? Suppose interest paid or interest payable, both are different. What treatment you have to do? Have you written?
Ma'am, I was confused how to write it.
Okay.
How do I publish it?
Okay. So now bills payable. See, again the payable word is coming. Bills paid means again it is an expense. There is a difference. Bills paid means some, like we have purchased something and that now we are making the payment. It's okay. You can treat it as an expense. But payable again means we have purchased any goods or anything, but we didn't make the payment. In future we have to make the payment. So it becomes liability. Whenever the word payable comes, you have to understand now it's a liability. It is not an expense. And what is the rule for liability? Whenever any liability increases, you have to credit the account. Bills payable is a liability. So you have to credit the account. Bills payable account should be credited. Now debtors account. Who is debtor? Debtor is a person to whom business has sold goods on credit. So goods on credit has been sold by the business to the customer. That customer is known as debtor. Now he will make the payment to the business in future and he becomes asset for our business. Okay. So debtor is a person to whom goods are sold by the business on credit. Now he needs to make the payment and he is asset for any business. Now whenever any asset increases, you have to debit the account. Whenever assets increases, you have to debit the assets account. So debtors account should be debited as it is an asset. Yes, Manjusha, lot of network issue dear.
Am I audible now?
Yeah, now you're audible dear. Now you're audible. So till debtors I thought. Debtor is an asset, so you have to debit. Okay?
Yes.
Yeah.
And I was asking that
Yeah.
bills payable or anything that's like has payable in it, would it become an outstanding expense?
Yes,
or
dear.
outstanding?
Yes, you are excellent. You are means right. It is outstanding expenses only. The other name for outstanding expenses are payable. Anything which has become due, business has not made the payment, is outstanding, and payable means also the same. So whether it is interest payable or interest outstanding, both means the same, both are liability. In future business needs to make the payment. The terms are different, meaning is same. Interest payable or outstanding interest, both are same. In future business needs to make the payment and it's a liability. Now it's clear to you?
Yes, ma'am.
Yeah. Any other doubt?
No, ma'am.
Okay, fine. Now 11th one, accrued commission account. So all these are new terms. Now what is the meaning of this accrued commission? Whenever the word accrued is there, accrued means already the business has earned the commission. Now it is the income for the business, but business didn't received that income. Now business needs to receive that commission in future. So accrued commission means income earned by the business, but business has not received yet. In future business will receive it. So accrued commission is an asset for any business. Whenever you see accrued interest, accrued commission means it is asset for any business. So what is the rule for asset? You have to debit always. Whenever any asset increases in the business, you have to debit. So accrued commission account is an asset. You have to debit accrued commission account. Understood, dear?
Yes, ma'am.
Okay. Now bills receivable again. Bills receivable or accrued bill, both are same. Receivable word has come means in future business needs to receive this bills. It is income for the business, but it has not received that income. It has earned that income. In future business will receive it, so it becomes asset. For example, in expense, what we learned, any expense paid immediately, it is an expense. Any expense which needs to be paid in future, it becomes liability. Same rule applies for our income. Any income received immediately, like interest received, commission received, it is an income. So income should be credited as per the rule. Suppose any income has earned by the business but needs to be received in future, like accrued commission or bills receivable, all these are income of the business, but income didn't received now. In future business will receive this income, so that becomes asset. Whenever any like income is not received immediately, in future that will be received, it becomes asset. So all the asset have debit balance. You have to debit accrued commission account, debit bills receivable, debit. Your concept is becoming clear, dear. What is the difference between accrued and received? What is the difference between interest paid, interest payable? Yes, Manjusha?
Yes, ma'am.
Okay, so write it down. Okay, everything write it down so that when you do the revision you don't forget. Yeah, just a moment. Okay, just a moment. Now next, page number 14. We can move to next question. Have you finished this question? Yes, Manjusha, this question has been finished by you. Manjusha, can you hear me? Yes, Manjusha, can you hear me, dear?
Yes.
Okay, fine. So now take page number 14, 1-4. Modern approach question only, clear. So now that clear concept is clear to you, like what are the rules of debit and credit as per modern approach? C stands for capital, L stands for liability, E stands for expense, A stands for assets, R stands for revenue. And whenever they increases, what you have to do, and whenever they decreases, what you have to do. Now state increase, decrease and nature of account. Okay, you have to say. The first transaction. Dinesh started business with cash rupees 5 lakh. So who is Dinesh here? If a person is starting business, who is he? He is proprietor of the business, means he is the owner of the business. So just go back to accounting equation. Whenever any person or any owner of the business just invest his cash, so two accounts are involved here. First thing is capital account and another one is cash account. So two accounts are involved here, cash account and capital account. So just prepare like this a tabular form. You can see page number 15. Accounts involved, nature of accounts, how affected, debit, credit. DR means debit, CR means credit. So in the first transaction, that is Dinesh started business with cash rupees 5 lakh, two accounts are involved. One is cash account, one is capital account. Now you have to think cash, what is that? As per modern approach, cash is an asset. So you can write asset account. And second, capital is capital only. In modern approach, capital account is capital only. C stands for capital, so you can write capital account. How affected? Whenever the cash or owner of the business brings into the business, cash is increasing. Cash is an asset and it is increasing. So whenever any asset is increasing, you have to write what? Increase. And suppose any asset is increasing means you have to debit the asset account. So in place of debit, you can write 5 lakh. Is it clear to you, Manjusha?
Yes, ma'am.
Okay. In the same way, capital. So what we learnt in modern approach, what is capital? Whenever capital increases, you have to credit the capital account. Here what is happening? Capital is increasing because Dinesh, owner of the business, he is introducing capital, he is bringing capital into the business. So capital is increasing. So whenever capital is increasing, you have to credit as per the rule of debit and credit in modern approach. So in credit CR column, you will write 5 lakh. Now the second. Any doubt in the first transaction, Manjusha? Okay. Now the second one. Borrowed from Naresh rupees 1 lakh. So who is Naresh? He is our, who is Naresh? Loan from Naresh. Naresh is a person. Yes, tell me, Manjusha.
Isn't Naresh a creditor?
No, see, no, he is not a creditor. Creditor means creditor is a person from whom business will purchase goods on credit. Okay. So suppose the transaction is written in this way. Purchased goods for 5,000 from some name. Okay. Then he is a creditor. But here he is not a creditor. But the business has taken loan from Naresh. So Naresh has given loan to business. Borrowed from Naresh rupees 1 lakh means Naresh has given loan, has provided loan to the business 1 lakh rupees. So two accounts involved here. Whenever any loan is taken by the business, what will happen? Cash will be increased in the business, cash will come. So cash will increase and the loan, that is liability, any loan taken by the business will increase the liability of the business. Now here two accounts are involved. First one cash account, second loan from Naresh account. These two accounts are involved. Now nature of accounts, cash account, what is the nature? Cash is an asset. So asset account, loan from Naresh. Naresh has given loan, so it's a liability for any business. So liability account. Two nature of accounts we identified. Now how affected? See, cash. If any loan is taken by the business, cash will increase. Okay. So you can write increase. then whenever any asset increases, what is the rule? You have to debit the asset account. So cash account you have to debit. Why you are debiting? Because it is increasing. Cash is an asset. Whenever any asset increases in the business, you have to debit the asset account. That is the reason cash account is been debited. Now loan from Naresh, it's a liability. Liability is also increasing. So now you have to credit. Whenever any liability in business increases, you have to credit the account. So loan from Naresh you have to credit as it's a liability and it is increasing. Yes, Manjusha, any doubt in the second equation? Okay. Now the third, purchased furniture for cash from Raj Furniture House, rupees 20,000. You should be very careful while dealing with this type of transaction. Why you should be careful? Because first thing, furniture is an asset. As I told you, the concept for asset and goods. First thing, it is not a good, so you can't write purchase account. Purchase account, sales account always we use for goods. If any goods are purchased, we write purchase account. If any goods of the business are sold, we use sales account. For asset, if we purchase any asset, name of the asset, like here it's furniture, you have to write furniture account. If any asset is sold, suppose furniture is sold, you have to write furniture account only. So always name of the asset is used for purchase or sale. But in case of goods, we do not use what? We don't use goods account. We use purchase or sales. Whenever goods are purchased, we use purchase account. Whenever goods are sold, we use sales account. Now one more thing, here they are saying that furniture is purchased for cash. Whenever the sentence says that it is purchased for cash, then even if name of the person from whom the asset is purchased given, you can ignore it, because they are saying that from Raj Furniture House they are purchasing. We have nothing to do with the name, because they are not our creditors. We are making the payment and then we are purchasing. Suppose for cash, this word is not mentioned. Purchased furniture from Raj Furniture House, then this Raj Furniture House you have to treat it as creditor, because we are purchasing asset on credit and we need to make the payment in future. But in this question it's not like that. Already for cash they are saying, then they are mentioning the name from whom furniture is purchased. So just ignore the name from whom furniture is purchased. Understood? Are you getting my point, Manjusha?
Yes.
Now what you will do? First, always you have to see which two accounts are involved. Furniture account is involved. As I told you, furniture is an asset. So you have to write name of the asset, furniture account. Second, cash. So two accounts are involved. Now nature of the accounts, furniture it is an asset. So you can write asset account. Cash is also an asset. You can write asset account. Now how affected? Whenever business purchases furniture, furniture is coming inside the business. So furniture is increasing. It is an asset and it is increasing. So increase you can write. And whenever any asset increases, you have to debit the asset account. So furniture account you will debit by how much? 20,000. What about cash account? Cash is also an asset, but it is decreasing, because when you means business is purchasing furniture, it is paying cash 20,000. So cash is also an asset, but it is decreasing. Paying cash means cash is decreasing, going outside the business. So now whenever any asset decreases, you have to credit the asset account. So cash account should be credited by 20,000. See how both like furniture, cash are assets only, but one asset is increasing, other asset is decreasing. Furniture is increasing, that is why we are debiting furniture account. Cash is decreasing, that is why we are crediting cash account. This is clear to you, Manjusha?
Yes, ma'am.
Okay. So now the fourth transaction, purchased furniture from Delhi Safe for rupees 40,000. Here they didn't wrote for cash. So you have to understand, unless until the question says for cash and the name of the person from whom goods or assets are purchased is given, you have to assume it is a credit purchase. Here purchased furniture from Delhi Safe for rupees 40,000 means they didn't say for cash. So this Delhi Safe is creditor for asset. We have purchased asset furniture for 40,000 and they are our creditors for assets. So there are two accounts involved here. What are those two? Furniture account, Delhi Safe account. Now furniture account, always it is an asset, furniture is an asset. Delhi Safe, liability. Business needs to make payment of 40,000 to this Delhi Safe because furniture is purchased on credit. Now how affected? Furniture is an asset, it is increasing in the business, you can write increase, and whenever any asset increases you have to debit. You have to debit furniture account by 40,000. Delhi Safe, it's a liability, business needs to make the payment to this Delhi Safe, it's a liability, liability is also increasing in business. Whenever any liability increases you have to credit the liability account. So Delhi Safe account you will credit, furniture account you will debit. Are you understanding the concept? Yes?
Yes, ma'am.
Okay. Now the fifth one. Purchased goods for cash 15,000. So now what is happening? Goods are being purchased. So what two accounts are involved here? One is purchase account, another one is cash account. Now purchase, it is an expense account. Cash, it is an asset account. We are doing as per the modern approach. So purchase is an expense and it is increasing. Expense is increasing. So you have to debit purchase account by 15,000. Cash is an asset but it is decreasing. You are paying the cash. So cash is an asset. When you make the payment of cash, asset is decreasing. So whenever any asset decreases, you have to credit the asset account as per the rule. So purchase account debit 15,000, cash account credit how much? 15,000. So for any doubt you are having there, till here, anything to be asked?
No, ma'am.
It's clear?
No, ma'am.
Okay. Okay. Now the sixth transaction. Purchased goods from Mahesh rupees 30,000. So here name of the person is given and they did mention for cash. It means it is a credit purchase. You have to understand in this way. Suppose purchase goods from Mahesh for cash is given, then you have to ignore Mahesh because since we made the payment of cash, so he is not our creditor. But in this question for cash is not mentioned means it's a credit purchase. Mahesh is a creditor to whom business needs to make the payment in future. Now which two accounts are involved here? You can take page number 17. Purchase account and Mahesh account. Mahesh is our creditor. Who is Mahesh? Creditor. So purchase as usual it is an expense. Mahesh, who is he? He is our creditor. Business needs to make the payment to Mahesh in future. Creditor means liability. So he comes under liability. How affected? Purchase is an expense and expense is increasing. So you have to debit the purchase account by 30,000. What about Mahesh? He is a liability. Liability is also increasing. If any liability increases, you have to credit. So Mahesh account will be credited by 30,000. Purchase account will be debited by 30,000. Are you understanding the logic behind these? Yes, Manjusha?
Yes, ma'am.
Oh,
Yes, ma'am.
okay dear, okay. Now the seventh one. What is the seventh transaction? Sold goods for cash to Kareem rupees 25,000. So goods are sold by the business, but again you have to be very careful while reading the question. For cash is written. For cash is written means you can ignore Karim. He is not our debtor. Debtor is a person to whom business has sold goods on credit. And now the debtor will make the payment to business in future. But Karim is not our debtor. Even though goods are sold to Karim, but he made the payment now because sold goods for cash is written. We have nothing to do with this Karim. So which two accounts are involved here? Cash account, sales account. Now cash, it is an asset. Sales, it is a revenue. Just a moment. Just a moment. Okay. So now two accounts are involved here. Cash account, sales account. Cash, it is an asset for any business. Sales is revenue. Revenue means income. Whenever goods are sold to customer, business earns income. Income comes under revenue. Now, whenever goods are sold, cash is coming. Cash is an asset, it is increasing. Whenever asset increases, you have to debit. So cash account will be debited by 30,000. And sales account, it is an income for any business, revenue. So whenever any revenue increases, you have to credit the account as per the clear rule, that is modern approach. Okay, any revenue, any capital, any liability, that is CLR, capital, liability, revenue. Whenever they increase in the business, always you have to credit the account. This rule you have to by heart. Whenever any asset, any expense increases, you have to debit, and vice versa. Once you remember any one side, the other you can do it yourself. Okay. So CLR, capital, liability, revenue, whenever increases, credit. Means whenever they decrease, you have to debit. Same. Whenever asset expenses increase, you have to debit, means vice versa. Whenever they decrease, you have to credit. So you should be thorough with these rules. Then only you can solve the question. So in 7, cash is an asset. It increases. So cash account is debited by 30,000. Sales is an income. It increases. So you have to credit sales account by 30,000. 7th transaction is clear to you, Manjusha?
Yes, ma'am.
Okay. Now the 8th one. Sold goods to Shyam on credit, rupees 30,000. Goods are sold by the business to Shyam on credit, 30,000. Now the question doesn't say for cash. It means it is a credit transaction. Now who is Shyam? He is a debtor. Debtor means asset for the business. In future, Shyam needs to pay to the business 30,000 rupees. Why? Because business sold goods to him on credit. Now which two accounts are involved? Shyam account, sales account. Shyam, he is an asset. Why he is an asset? Because he is a debtor for the business, and debtors are assets. Now whenever any asset increases, you have to debit. So Shyam's account will be debited by 30,000. What about sales? Sales is a revenue. It is income for the business. It is also increasing. So any income increases means you have to credit. Sales account will be credited. Shyam's account will be debited. Any doubt, dear Manjusha? Okay. Now the 9th one. Cash received from Shyam, rupees 20,000. Okay. So Shyam, who is Shyam? Shyam is our debtor. We need to receive cash from him, 30,000. Okay. But at present he is making payment of 20,000. So two accounts are involved here. Cash account, Shyam account. Now both are assets only. Cash is also an asset. Shyam is our debtor. So debtor is also an asset. Both are assets. Now which one is increasing? You have to see. Whenever Shyam is a debtor, he is making payment of 20,000. So cash is coming inside the business. Cash is increasing. So you have to debit cash by 20,000. Since cash is an asset and it is increasing, that's why you are debiting cash by 20,000. What about Shyam? Shyam is also an asset because he is a debtor. But what is the difference? He is making payment to the business Now our debtor will get reduced. Asset is getting reduced. If you are receiving 20,000 from Shyam and he is your debtor, means you will subtract 20,000 from Shyam's account. So debtor is decreasing. So asset is decreasing. Whenever any asset decreases in business, you have to credit. So Shyam, one asset is decreasing, you will credit. Cash is an asset, it is increasing, you will debit. It's clear to you?
Yes, ma'am.
Okay. Now the 10th transaction. Cash paid to Mahesh. So who is Mahesh? He is our creditor. Business has purchased goods on credit for 30,000. But at present, business is making payment to Mahesh 20,000. So which two accounts are involved? Mahesh account, cash account. But you have to remember who is Mahesh? He is creditor. Creditor means liability. Cash is an asset. Now, when you make payment to any creditor, your liability is decreasing. Business liability is decreasing. Whenever any liability increases, you have to credit. Whenever any liability decreases, you have to debit. So Mahesh, he is a creditor. Making payment to Mahesh, liability will decrease. So you have to debit Mahesh account. What about cash? Whenever cash is being paid to Mahesh, cash is an asset, it is decreasing. Whenever any asset decreases, you have to credit the asset account. So Mahesh account you have to debit by 20,000 because liability is decreasing. Cash account you have to credit by 20,000 because asset is also decreasing. So liability is decreasing, asset is decreasing. Understood, Manjusha?
Yes, ma'am.
Any doubts so far you are having, dear? Anything to understand? Anything to ask?
No, ma'am. It's
Oh,
clear. It's quite clear.
okay, dear. So till here today we will keep. In the next class we will continue with our next questions. Okay?
Yes, ma'am.
Yeah. Thank you, dear.
Thank you, ma'am.
Good night, dear. Thank you.